been a really interesting week as far as euro dollar is concerned. Both central banks having the say in the course of a week. And also on top of that, we've had plenty of economic data as well to really just add colour to the picture here and give us some insight into where this currency pair could potentially be headed. Last week, we heard from the European Central Bank. At the time in the meeting itself, it seemed that the central bank and policymakers within the bank were actually quite at ease with the movements that we'd seen in the currency, the euro gaining quite considerably over the course of the last 6 to 9 months against the US dollar, up around 10%, I believe, at the time of the meeting. That's an incredible move in a currency pair in such a short period of time. And typically what you would hear from central bankers after a move of that kind would be warnings. So they'd be giving warning signs about the potential negative implications for the strength of the currency, not just economically, but also on their inflation targeting. Because while policymakers do not target FX rates, normally FX rates do move more slowly, so they won't have a major impact as far as inflation is concerned. When they move rapidly, they can have a far more significant impact. But policymakers did stray away from this, and the markets kind of took this as a sign that they could have a free run at 120. And this is the level where we'd previously run into a little bit of resistance. Traders potentially anticipating warning words from the ECB, which didn't come. What followed on Friday, Saturday, and Sunday was a number of policymakers, including eventually the President, Christine Lagarde, warning that the currency can actually have an impact, that they are monitoring the strength of the currency. They don't target currency rates, but they are monitoring it, effectively saying, please don't see this as a sign that you can take a free run higher, that we can continue to tolerate higher rates as far as the euro is concerned. So that was a really interesting development that really kind of got shrugged off by the markets. Now we're going into the Fed meeting in the middle of the week. A month ago at Jackson Hole, the Fed chair, Powell, issued out the new guidance as far as the monetary policy framework is concerned at the Federal Reserve. It was only a minor adjustment, really, but the markets really did jump on it. And it is significant if it's followed through as it's intended. They've changed the inflation target from 2% to averaging 2%. Now, that's important because they've undershot inflation for such a long period of time. What it effectively means is the Fed can now afford to go above its inflation target, and that flexibility on the upside will enable it to, A, ease monetary policy further, potentially, between now and when they decide that they need to raise interest rates, but more importantly, B, keep interest rates lower for longer. So effectively more easing as far as the world's largest central bank is concerned. So this was a bullish signal as far as these markets were concerned. Easy monetary policy has typically been good for these equity markets, and even to an extent weighed on the US dollar as well. Pushed US yields back to these record lows where we currently where they're currently trading around. But what's interesting is, while the framework has been has evolved, whether that actually affects policymakers' decision making is concerned, that is what we're going to learn about later on today. What's the Fed going to change as far as their actual stance is concerned? The difficulty that they now have is that a lot of the data has improved. Inflation is higher than it was expected to be at this point. So there is going to be these inflation fears, which are maybe starting to breed within the Federal Reserve. There is also the fact that growth is better than it's expected. The OECD actually significantly revised up the US growth forecast for this year only earlier on today. The previous forecast in June was for a contraction of 7.3%. That's been revised up to minus 3.8%. That's a 3.5% swing as far as the OECD is concerned. You can imagine that Fed policymakers are probably coming up with pretty similar forecasts themselves. So whether this actually means that we're going to see more easing from the central bank, or how much longer the interest rates are going to be lower for, is going to be interesting. Ultimately, if we see disappointment, that could cause a spike in the dollar. And as you can see on this chart, we've already seen the dollar performing relatively well. That could drag it below, having already broken below that trend channel, and could potentially see that correction really break free, having stalled to this point so far.